valuation framework proposed for secure lending, termed prudent value. I'd like to thank everyone attending today. We're very glad you're able to join us. My name is Jonathan Fothergill, and I'm a Senior Specialist within the RICS's Investment and Valuation Advisory team, and I'm also a Chartered Valuation Surveyor. I'm delighted to be joined this morning by two experts with a great deal of experience and knowledge in this area of prudent valuations, Neil Crosby and Chris Fawn. Neil and Chris have both been part of the European Research Forum researching prudent property valuations across Europe, and are also both members of RICS's Global Valuation Standards Expert Working Group. Neil was Professor of Real Estate at the University of Reading from 1994 until taking retirement last year, but as Professor Emeritus of the university is still active in the school. Welcome, Neil, and thanks for joining this morning.
Hi.
Hi. Chris Fawn is a senior valuation professional with many years' experience, primarily in the UK real estate market, and runs his own consultancy, Valuology, which is concerned with reducing valuation risk. Welcome, Chris, and thanks for joining.
Thank you, Jonathan.
Thank you, Chris. So the objective of this webinar is to inform you what is coming down the line from the PRA's implementation of the Basel III standards, along with the potential implications of this for valuers and users of valuations, both commercial and residential. This process is something which RICS has been actively involved in through its ongoing work with the European Research Group sponsored by the Investment Property Forum, and also through engaging in ongoing dialogue with the European Central Bank, the Bank of England, and industry-wide stakeholders here in the UK. Although the implementation process is at a much more advanced stage, in Europe, in its role as the independent regulating professional body for property valuation, RICS are keen to proactively work with the PRA and the European Bank in helping to shape a potential solution, which will ultimately lead to a successful, cost-effective and straightforward implementation of a prudent valuation framework. And importantly, one which does not disrupt the market and ensures transparency and consistency of approach, therefore upholding the public advantage. So the programme for the next hour, we'll start with a presentation from Neil, who will inform us of the details of the prudent valuation regime proposed by Basel III back in 2017, and currently the subject of the PRA's proposals. Neil will talk to us about how we've arrived at this stage and the problem prudent value is looking to fix, along with what ultimately may be an appropriate response based on the research undertaken to date. Following Neil's presentation, there'll be a discussion with our two speakers on the key aspects of the PRA's proposals. And there'll be time for any observations and questions from you, the audience. So please feel free to send us these via the special Q&A facility following Neil's presentation, and we'll do our best to address them within the time frame. Just by way of a practical point, just to let you know that all external mics, cameras and the Teams chat facility have been muted for this session, and that the webinar is being recorded with a link to the session to be made available subsequently. Therefore, without further delay, if I can please pass to you, Neil, to run us through your presentation. Thank you.
Thanks, Jonathan. I'm going to try and share my screen, but we haven't been having trouble with that first thing this morning. So
just let me know if you need help with that, Neil.
Yeah. Are we getting there? We're not, are we?
Not yet.
Have you got mine or not? I've got my slides up. I don't think you've got them, have you?
No, I'll share your screen then, Neil, and just prompt me when you want to move forward.
Okay. Right. Okay. Thanks very much, Jonathan. Welcome everybody. My name is Neil Crosby. I'm Professor Emeritus, which is just a posh way of saying retired. But I've been working with the industry on this for, well, ever since it started, which is, of course, is post-global financial crisis. So, Jonathan, if we could have the first slide. This proposal has come out of Basel III, and in 2017, they proposed a new prudent valuation regime. Now, that is now under consultation in the EU, and the EU have already come to a decision that they will be implementing it, and they're now in implementation phase. Whereas the Prudential Regulation Authority, which is part of the Bank of England, is actually currently running a consultation, and I believe that finishes. It's either the last day of March or the day. It's 30th or 31st of March for the, and RICS is obviously, along with a few other bodies, putting in consultation responses. I've called it potential outcome, but it's actually a potential nightmare scenario as far as I'm concerned. And that is that when they actually come to implementation, which is due on the 1st of January 2025, a prudent value will be required for each individual loan origination and any subsequent monitoring valuations across the whole of the EU and the UK for every individual property. So if you're a property valuer anywhere in the UK and elsewhere, the nightmare is that you will be asked to do a completely different valuation to the one that you've grown up with and are all very well used to, obviously market value. There is a definition, and I've set it out, and I've put the sort of what I think are the nightmare scenario bits for you, which are in red. And that is that the value of the property must exclude expectations of price increases, must be adjusted to take into account the potential for the current market price to be significantly above that would be sustainable over the life of the loan. And if a market value can be determined, the valuation should not be higher than market value. So the implication is that there's a different kind of valuation to be required, and it can be benchmarked against market value. So the bright spark in this is that there is a market value aspect within it, but it's not market value. Now, Jonathan, if you could move on one now.
Sure.
Right, so I think a bit of history here. I mean, the obvious driver for this is the global financial crisis, although I would suggest that there's been two other drivers for it, because we've had banking crises in 73, which I can actually remember because I was actually working in 1973, which I think puts me probably in a minority in this particular one. But of course, 1990 as well, where we had two. Basically, in 73 and 1990, we had two market downturns, commercial property I'm talking about, not residential in this particular case. We had two of those that were as severe as the downturn in 2007. But obviously, it's 2007 that has been the driver for this, or 2007 to 9. And the regulators have now, after first ignoring real estate as anything important until the global financial crisis, post-global financial crisis, they've taken a little bit of interest in this, and definitely the central bank in the UK, more interest than probably anywhere than anyone else. But they don't believe that market value on its own is the right valuation to be asked for from the banks to the valuers. They recognise that it's an exchange price only. They recognise that it has no shelf life, basically. So a market valuation doesn't tell you where you might be in the future. And that's part of their wish list, which I'll get onto in a minute. There is a view that it's pro-cyclical. In other words, using market value actually adds to property market cycles, or adds to the volatility of the property market cycle. Now, we could have an argument about that, and I'm sure some of the academics on the call would. But there is a view that as the market values rise, that gets higher loans, and that the weighted all this sort of stuff drives the booms up and creates more the downturns are worse because of it. So they believe that's for sure. They actually believe that part of the argument. And it is a fact that most losses occur in the last 2 years of any boom. So if you add to that all the stuff that I'm sure there's some valuers on this call who will point to where they've been pushed and bullied and I'm sure they haven't given in to it, but borrowers and lenders have been trying to sort of borrow a little bit more, and that happens in those times when markets are characterized as very good. I would characterize them as very dangerous. So Jonathan, can you move on, please?
Yes.
Or move me on, I should say. So I think the financial regulators have a wish list, and they want a shelf life which market value doesn't give them through the loan. They know that actually there is already a defined valuation called mortgage lending value, which I'm going to characterize as an under the cycle model, and it's a very prescribed valuation that's quite prominent in mainland Europe, particularly the Germanic countries and Spain. And that mortgage lending value has actually been going for since 1900. So it's been going a long time, and there's been a built up a basic way of doing it, which is completely prescribed. And my view is that mortgage lending value is not a valuation of any use to anybody. And even I believe the Pfandbrief banks in Germany, who have to use it for some of their activities, they don't like it either. So there's very little support for that. The Bank of England have had a look at that one and do not like it because they think it's too conservative and actually doesn't do the counter-cyclical work that they would like a valuation to do. So that one has been sort of pushed aside to an extent, certainly within the UK. Now, Basel III has come up with, I'm going to be rude about the banking and finance community now, so if they're on this call, I'm very sorry, but Basel III has come up with this new prudent value definition. It pays lip service to mortgage lending value, but it's not quite the same, but it does have many of the properties of mortgage lending value. But I don't think anybody is really going down the route of actually saying that mortgage lending value will become the new prudent valuation. I may be wrong in this, and I may, in 6 months' time, when the EU come up with their new proposals, it may be in there, but I don't think so. But I think what is really worrying for the real estate community is that, as far as I can tell, nobody has actually talked to us about property valuation. In other words, they know best, and the banks know what they want, and the IMF, who've had some work on this, done some work on this, as well as the Basel Committee. I have no evidence that they have talked to anybody who knows anything about property valuation. So they come up with this valuation and then ask, basically, we might be the ones who are asked to implement it. And I find that, shall we say, difficult to live with, and I'll leave this at that. I could be a lot ruder. So, Jonathan.
Yeah.
Next one, please. I think there are 3 alternatives, and I think that the first one that I think a lot of valuers would rather like us to do is argue that market value is appropriate and is prudent. It even has the word prudent in it, but I'm sorry, I really don't think that fills the bill, and I don't think the regulators think it does. And if the industry starts to try and defend market value as the sole basis of valuation for bank lending with no other nothing supporting it, I think we're going to be told that's not going to be the outcome by those who are in charge, i.e. the regulators. Now, unfortunately, in Europe, the TGOVA, which is the European Group of Valuers, I think are going down that route. And as I say, I could be stronger, but I think that option is devoid of any rationality sense, and it doesn't address the cyclical issues that are behind the problem that the regulators have identified for real estate. I also think that if the prudent value is tied to market value and is an individual property valuation, then there's going to be a negligence minefield, and I'll get to that later, right at the end, in hopefully not too many minutes time. But I think there's a major issue for us as individual valuers if they go down the route that there is a prudent value to be noted along with market value. So the nightmare scenario is that individual values for individual valuations will be asked to provide a market value and a prudent value, which isn't going to be the same. It might be the same, but it might not be. And for individual valuers, that's how do you decide when you change the market value or use a different prudent value to market value, and when you use prudent value equals market value. So I'll try and talk about that in a moment as well. Now, we could try and develop this new valuation method at the individual asset level, and that has been looked at, but I don't think that is a option either. And so, but I think before I get on to what I think the real option is, and the one that the industry should be pushing, there's been a lot of talk about under the cycle and through the cycle valuations in all of this. And so I just want to, Jonathan, can you just move before I get to number 3, can you just move the slides one forward, please? I've got a very simplistic diagram, which I hope explains it. And it was actually, this diagram is from the RICS guidance note on bank lending valuations, which was published in 2018. And it basically just says, look, the problem is that market value goes up in the cycles, which is the blue. And of course, it doesn't really look like that, but you know what I mean. What would be the perfect solution would be if we could smooth the cycles so that when market values were overheated, you can use any word you like, but I'm going to use the word overheated because somebody else did it quite recently. When markets are overheated, what you want is a valuation that does not follow them up. And therefore you want a prudent value that is lower than market value in those circumstances. Now, ideally, when we're in the bottom of a trough, that is the perfect time to lend. But of course, the way in which markets have worked in the past, that's precisely the time when the banks are restricted. So what we would love really is a long-term value through the cycle that told us when things were underpriced as well as overpriced, and we could actually try and almost encourage more lending when it looks like it shouldn't, i.e. at the bottom of the cycle, and less lending when markets are characterized as wonderful and good, as they were in 2005-06. But they weren't good, as I said before. They're dangerous when they get to that sort of state. And mortgage lending value goes right down at the bottom all the way through, and that is an under the cycle model. So what I think we should be looking for is a through the cycle model, but because the Basel III definition of prudent value says it's defined has to be it can't be higher than market value, what you're going to have to look for is, can we identify a through the cycle model that tells us basically when things are overpriced and restricts, but we can use market value when things are shall we say in the down cycle part of the cycle, the down part of the cycle. So the UK industry has been looking at this for probably about 10 years. So can we have the next slide? Right, now, I think the developing a sort of through the cycle type model, actually there is one. It's called investment value, and when institutions are buying property, every time they will do a valuation that isn't market value. They'll do market value because they want to know what price to pay, but they'll do an analysis of that price, cash flows, etc., etc. And that actually is a through the cycle model. But could you imagine having to do that kind of analysis for every single individual property? Okay for some of the big stuff, but not for the rank and file small properties that do not have the same sort of data sets behind them to do that kind of job. So what we've been trying to do over the past from about 2013 onwards, when a number of interested stakeholders in the UK property industry and real estate finance industry came together to try and identify how the UK commercial real estate industry should respond to the global financial crisis and the criticisms that were coming their way from regulators. And they put together a thing that some of you may have seen, and I've put it in the bibliography at the end of the slide so that you can access it if you haven't seen it. But it's called A Vision for Real Estate Finance, and it came up with 7 recommendations. And one of them that we would develop a long-term value model, and also a lot of data stuff and all sorts of other things. But basically, the only one of those 7 recommendations that has really got any legs is this one, which is the long-term value type approach. And the way in which that's developed has not been at an individual property level. What it's been is to try and work out market value adjustment factors at a market segment type level. So a lot of work's been done from about 2014-15. There was a preliminary report published in 2017, and then ourselves at Reading and Cambridge universities came together to do some work funded by the Investment Property Forum, who have funded most of this work, and we've come up with sort of modelling of markets, and we've tested that modelling against the 1990 and 2007 crashes, and if we had used that kind of market value adjustment factors, i.e. analysis of price modelling, we absolutely identified both the 1990 crash and the 2007 downturn or crash, whichever way you want to call it, at least 2 years before it happened. And that fits the wish lists of the regulators absolutely perfectly. Now, it doesn't identify COVID type, pandemic type downturns, but where pricing is can be looked at economically to see if it's over or under pricing, then those models have worked and they've been developed. And so we've done that in the UK already. So if the UK property market wants to avoid having individual property valuations of prudent value for each individual asset, then to me the way forward is that we put the prudent value, in a sense, in the hands of the market analysts rather than in the hands of the valuers. And I think that would be the right way of doing it. And as I say, we've already shown through the work that's been done with the industry, with our ICS, with IPF support, and with Bank of England support, as it happens, to actually develop these indicators. And they have been seen to work, not in hindsight, using the data that was available in 1990 and in 1988, 87, and in 2004, 5, and 6. They have been shown to work on those kind of criteria. So, Jonathan, can you move it on? and that's the actual, I mean, I've just picked one of the slides out of the research just to show you. That is just saying how much the modelling showed the property markets to be overpriced at the time. And it's just a very broad all property indicator. But there are some commentators on this who think that a broad single country all property adjustment factor will do the job for the regulators. In other words, property markets tend to move in tandem. Yes, of course, retail goes at a different level to than industrial or logistics or whatever, but the booms and the busts tend to be property market booms and busts and not individual segment. And so basically you could actually sort this whole issue out by producing single indicators at an all property level of over and under pricing. And as you can see in the pre-1990, the modelling was suggesting that the market was 30% overpriced, and pre-2007 it got to a peak of nearly 40% overpriced, which is pretty much what happened. So, but the overpricing appears, I mean, if you can look, I know the graph is very small, and you probably can't see it, but we were able to say that even by 2004 and definitely by 2005, the markets looked to be sort of heading towards 20% overpricing. So if you have some kind of parameters about how much, what level of overpricing starts to look dangerous, it gives the regulators time to act if they haven't, but obviously they've got to give themselves the powers to act, but that's up to them. So there is we think there's a solution to this problem. So Jonathan, can you just go to the I've got two, I'll do it very quickly now. There are two slides. One is the findings and one is the summary. And basically, we think there is an opportunity here to try and inform the finance people that a individual property valuation to a completely obscure definition called prudent value is going to be extremely difficult for them to do. And actually, Jonathan, can you just go to the last slide, because the time is going. And I think the real problem is that the middle bullet point, the level of data and particular skills, the expertise of the valuers and the investors, is that I think the solution has to be that we do a prudent valuation equals market value at the individual asset level, and then we try and develop these market adjustment factors. They're going to have to be developed by the industry and not by individuals. So it's, I mean, Europe's got a problem with data. We haven't. The UK is much further on in this than Europe is, even though Europe are pushing the implementation. So there's a real danger here that Europe will come up with an implementation plan that's totally unrealistic, but the UK regulators want to follow what Basel and the EU and be as close as they possibly can to them. And so if the PRA might, in its, I'm going to say it, in its ignorance, might come up with exactly the same inappropriate solution. So I do think the UK property industry has got to shout from the rooftops that it has solutions to this, if you believe these solutions are feasible. And of course, you know, I think they are, obviously, and the researchers all think they are. It's whether you all think they are that matters, though. But I think there's a nightmare scenario, and that is you being asked to do these valuations, because I think some of you will, and I'm talking to the valuers now, I think some of you will adjust and just say, well, I'm going to be conservative, I'm going to use market value, but I'm just going to reduce it. Some I think will actually go into all sorts of analysis if they have the data and the time, and will start perhaps to sort of do some kind of market state and adjust, but some will, some won't. Inconsistency will be rife, and there will be no real indicator of crisis for the regulators coming from that inconsistent set of numbers. And worse still, you know what the banks are like when it goes wrong. They always want somebody else to blame, and it's always the valuers. In 1990 and 1973, the crashes were followed by negligence claims. So if we have another crash, why should it be any different? And I think it's going to be far harder for valuers to defend a prudent value than it is for them to defend a market value. And I think the inconsistencies in prudent value will be greater than the inconsistencies in market value. And that's going to be a PI insurance nightmare. It's already a nightmare, but I think I suspect there are already some discussions going on between the insurers and the RICS and valuers, and I'm not sure that it's a very happy conversation, because the PI insurance, you know what they do, if the claims go up, so do the premiums. So I do think there's a major sort of negligence nightmare scenario on its way if the regulators get this one wrong. That's it, Jonathan. I think I've said more than enough.
Okay, thanks, Neil. I'll take your presentation down. So I suppose really to sum up from your presentation, Neil, from the perspective of the valuer, that the message is really to carry on as is, and then at a national level, it has to be some kind of market-based adjustment factor, which essentially protects the valuer and ensures the consistency. Prudent value shouldn't be assessed at the individual property level, and this is potentially an approach which can be adopted across Europe also. Could I bring you in, Chris, at this stage? I mean, just did you agree with Neil's proposed solution there, Chris? Did you have any more thoughts on this?
Yes, I mean, fundamentally, I agree with a lot of Neil's what Neil says and his overall conclusions. I think I've got subtly different views on some of the operational aspects of this from a banking point of view. But I think we had to realise that, I mean, Basel III has been around in the first. Basel III is not a single document. It's been evolving. I mean, the first things labelled Basel III came out in 2009. This particular amendment relating to real estate collateral didn't come out until 2017, and 5 years on, we're still now looking at the national regulators, the European-wide regulators and the PRA in the UK, looking at implementing the provisions of that, which set a high-level framework. And I would also, one point where I would just distinguish himself from what Neil said is that Basel III doesn't actually define prudent value. It sets out a framework of criteria, but it's quite clear that the implementation of this has to be decided at national regulatory level. So that's where we may see some subtle variations, and we're beginning to see from the debate that's been going on in Europe over the last couple of years, and I'm sure is going to be repeated in the UK with PRA, because at the moment, following Brexit, the UK's just imported the old CRR regulations, credit risk regulations from the EU into UK law, but now, of course, they're being revised, and so the EU and UK are probably moving in parallel, and I can't see them diverging too much, but they both are now responsible for their own regulations.
And just coming back to you, Neil, I mean, what's your sense from your discussions with the PRA to date in terms of the principle of market adjustment factors? Do they themselves, are they seeing this as a model solution at this time? Are they receptive to what you're telling them?
Well, as they haven't discussed it with anybody, then we have absolutely no idea. And that's one of the problems, is that I think there are moves to try and get discussions with the PRA, and the PRA is part of the Bank of England, and the Bank of England financial stability section and they have people who deal with commercial real estate in that section, have been engaging with the industry since 2013-14. But I'm not sure how much I'm allowed to say, because I've been in sort of confidential meetings inside the Bank of England. But my take on this is that there hasn't been a huge amount of communication yet, or before they put the consultation out, there hadn't been a huge amount of internal discussion within the Bank of England, let alone external discussion. And so I think, you know, that's one of the problems. If I was a regulator who didn't know anything about property valuation, what would tell me that this wasn't totally deliverable? I give the valuation to the valuer and they produce the valuation under the, and Chris is quite right, this is a framework, not a definition. And I agree absolutely about that. So that's why it could be implemented differently in different national organisations. But to me, I think what may well be the outcome, unless there's a lot of unless they read the consultations from the UK property industry, that there will be a view that prudent value could be an individual property valuation done by individual valuers. And the valuers are going to, I think, I mean, I hope this doesn't sound rude to valuers who are listening, and I do apologise if it does, but your expertise is grounded mainly in market value. And this is, to me, is a whole new ball game. And the idea that you've got to put in a lot of work to sort of do some quite sophisticated market analysis to try and work out where we are in cycles, and then come up with a consistent answer between all of you to protect you a little bit from my negligence scenario, nightmare scenario. I just don't think these people at the PRA have any idea of how difficult it might be to implement. So they just think, well, of course they can do it. Oh, we'll just tell them to do it and they'll do it. They do market value. Unless we tell them, I think they're going to come up with well, do some prudent values, please.
Chris, if I can just come back to you, please. I mean, it seems that the PRA seem generally nervous about real estate generally. Given the proposals, I mean, the prudent valuation proposals are just 10 pages of a 400-page document. That there's a lot in there relating to risk adjustment of real estate. I'm just wondering what your view is of the overall impact of these proposals, and if they're ultimately likely to restrict lending and make it more expensive, and the potential impacts of that on our market. I mean, it obviously comes at a time when we're looking to assure the UK's long-term housing supply, to prevent stranded assets and to transform, you know, the built environment and move towards net zero. Do you feel that this will significantly impact or has the potential to impact on all of those aspirations?
Well, yes. I mean, I think the biggest concern, and it's not really directed relevant to the valuers, is the risk weighting adjustments, which the whole purpose of this paper is looking at updating the way in which banks' solvency ratios are calculated. And in calculating that, they have to risk weight their various assets, and those assets include loan collateral, and amongst the loan collateral they've got real estate. So it's part of a very much bigger regulation of the banks. And the valuations are used and then are risk weighted. And I think the fact that they're looking at putting some higher risk weighting on certain types of real estate loan collateral is going to have a bigger impact on the availability and cost of loans, which could be adverse. But that's nothing to do with prudent value. That's a sort of separate a separate aspect of this.
Is it effectively a double whammy in effect,
Yes.
but the prudent value and the separate adjustment factors?
I mean, we don't know. I mean, it depends which way they go in terms of what the basis they use for deeming a valuation prudent, because you have a situation where at the moment, under the current European credit regulations, you can use market value or mortgage lending value, where you're a state which has strict regulations on how it's used, which is Germany and a few of the neighbouring countries. But when it comes to the CRR regulations, they say that, well, because mortgage lending value is more conservative, it comes out at a lower figure than market value, you're allowed to adopt a lower risk weighting on it, which means it effectively cancels out the impact. So you're discounting the valuation, but then also allowing it a lower risk weighting. So when it comes to calculating overall risk, it doesn't make much difference, frankly. So I think the two things are related in that respect. But you know, I'll come back to the fact that I don't think market value is not a prudent value. I mean, if you ask any valuer out there, is your market value prudent? Well, they're going to say, well, of course it is. I mean, what else is it going to be? Reckless? I mean, I think if we took any of the antonyms to prudent and applied that to the market value, I think your professional indemnity insurers would be quite worried. So we're part of a sort of very complex web here, and I think what we just got to make sure is that this whole concept of prudential value, prudent value, doesn't suddenly grow legs and come into some. And we're absolutely right when Neil says it's not something which valuers should be determining, certainly at an individual asset level, and that I completely agree with.
Is a potential consequence of this and introducing a prudent valuation framework ultimately that market value is just driven up? Is that a potential?
No, it shouldn't be. Market value is market value. There's nothing about prudent value which suggests that it can be the same as market value. It may be. I mean, actually, if you look at the Basel framework, it does actually say that you have to ignore aspects of market price, which may not be sustainable over the long term, not market value. So consequently, I mean, it's recognising the fact that parties may agree a price which is in excess of a value which is prudent, which I would say is also in excess of market value. So I don't actually see that as too much of an issue.
Okay. Neil, if I could just come back to yourself, please. Just in terms of the market adjustment factor solution, and based on the ongoing research, I mean, how far away are we from having a potential solution with that? Is there a model in the making that's on the shelf potentially in time for implementation, or is it a lot further away? Right.
Yes. I mean, the answer is very simple. Yes. I mean, the Cambridge Reading research developed those models. It tested everything from a very basic past trend model, literally putting a line through the last 15 years, which has been done. I mean, there's one consultancy firm that does that and provides banks with that information already. And that's that's and they call it an adjusted market value factor. and we did it all the way through to some sort of more sophisticated equilibrium modelling. We looked at investment valuations, you know, in other words, straightforward cash flows using anticipated growth rates, cap rates, and all sorts of things. And we tested each of those models against the 1990 and 2007 crashes. And, you know, and the 1990 crash was an occupier market crash. It was a rent crash, basically. And 2007 was rents were absolutely stable, or relatively stable. I mean, it was, and that was a cap rate. You know, I mean, if you track the cap rates through 2004, 5, 6, I mean, you just see them going. You know, the trend is downwards, quite a significant downward trend. So. But the models we adapted, we had the cash flow models actually didn't get the occupier crash. So just using a typical cash flow, didn't find 2000 and it found 2007, but it didn't identify 1990 because the forecasting was not very good at that point. Now, I'm not suggesting that forecasting hasn't improved dramatically since 1990, but at the time it forecasted that rents in 1990 were growing at 10%, and of course they fell by about 25. So you know, it sort of, so no, the cash flow models didn't pick it up, but trend equally what some econometric models did. But the point is that is not the basic diet of the valuer. You know, doing econometric analysis of property markets is the market analyst function. And to me, it's so prudent value isn't a valuation. It's a market analysis of the current price, because what you're trying to do, it's not about individual assets. This is about picking up market cycles, and we only have problems when we have cycles. And although Gordon Brown suggested once that we'd got rid of market cycles, I think we all know now he was wrong. And so I think you've got to try and identify where we are in the cycle. And market analysts in you know, in some of the major consultancies, in major firms and PMA and all this lot, all the forecasters are doing that on a daily basis. Now, we're not going to say they're going to get it right every time, but the tests showed that when we get into the major problems, not the minor cycles, but the major cycles, it got it right both times. So if we get into another economic boom bust situation, we are fairly confident that those sorts of models could pick it up, and therefore the bank regulators will have those early warning systems. And if the lenders choose to ignore them, and the regulators choose to ignore them, well, fine, that's their, you know, but at least the property industry has it in itself to actually produce something that will help. What will have to happen is that organisations, and you know, I'm not going to name them, but RICS might be one of them, I think have to try and, because the data needs funding, the data is in private hands. And when we did all the research for the IPF, part of the funding for the research was to buy the data from the likes of MSCI and others. So, you know, it's not in the public domain, so there will need to be sort of, let's say, biannual, you know, refiguring of each model. You're going to have to monitor the model to see how well they are working by, you know, they said they picked up that amount, what happened in the next 5 years, all this sort of stuff. You keep trying to improve the models, which is what everybody's doing all of the time. But the basic idea is there. And it has been done successfully. So the existing models could be updated every 6 months. Somebody has to collect the data. Somebody has to be funded. The regulators, I don't think, will do it themselves. They will be delighted if the property industry put, you know, so many thousands, you know, of its funding into, like the IPF does consensus forecasts every 3 or 4 months. That sort of thing, you know, that it's a repeat of that kind of process, but the industry has got to do it, and it can't really come from an individual firm. I don't think it's got to come from some kind of amalgamation of the industry helping itself and helping the regulators.
Okay.
would sort of I just add to that
Mhm.
I mean it is publicly known that the European Central Bank has actually got a big exercise on at the moment to look at commercial real estate lending. I can't go too much into the detail, but I do know that they're examining quite closely the methods in which individual banks across the Eurozone are calculating the figures they need for their statutory reporting. And I mean, for every loan, they have to constantly monitor and update loss given default. So in other words, what would the bank potentially lose if there was a default on the loan? They had to rely on the collateral, the value of the real estate. So they are picking up falls in the value of real estate as part of that process, or should be. And also, they've got, alongside looking at the loss given default, they've got to also calculate the probability of default. So there are two aspects to this. And when they combine the two, they come up with overall figures as part of their risk assessment. And this all has to be reported. What is coming out of this is that they're not all banks are equal, put it that way. Some are very, very crude and frankly quite lax about it. And I think this is where Neil's fact, if there is an accepted model which can be used and promoted across the market for looking at trends in real estate and reliable data, which these banks are relying on, it's just relying on the guesswork of some chap sat in a back room somewhere in a bank which doesn't have any real contact with the market, doesn't have available data, then that will certainly help the overall picture. But again, this is far removed from your valuer in the street.
Yeah. Neil, would the models drill down on a sector by sector basis, and how would they deal with geographical variances and such, or would it be an all property style model? Could you just share some thoughts on how you see that panning out?
Yeah, I'll share some thoughts, but definitely not an answer, because I think the jury's out. There are some who think a single all property indicator is actually sufficient for this particular job. I mean, the work we did in the Reading and Cambridge, and I'm the quantitative idiot in that work. And so, you know, and the others were not valuers, that's for sure. They were the sort of econometricians and what have you. And what they did was, for some of the models, they put some very specific inputs into the model for retail, industrial, or logistics and offices. So some of the models, the most sophisticated model was the one that identified the changes most accurately, but they all showed the big picture. So even the absolute basic models. So this is why I think Europe could sort of adopt the same approach. What would happen is that in some countries like Romania, for example, and I'm picking that out of the air, it could have been any of the less mature economies, that their data sets are obviously much inferior to those that we've got. We've got the best, and the rest of Europe, in a sense, goes down below. I mean, one of the reasons we're the top of the JLL Transparency Index is, I think, because of our data sets, which are so good. And I don't just mean MSCI. I mean, you know, you can go through all the major firms and all sorts of things. But we've done some work, preliminary work at the moment, and in fact we're about to publish it on what the different correlations are between the let's say, you know, a city in the UK and the All Property Index, and you know, if you track it, they do move in similar directions, not to the similar extent. So you know, the models could get more and more disaggregated, and I think that would improve the outcomes. But whether it improves the outcomes enough to change the big picture, I'm skeptical about. So I think some very crude indicators could do this job. And if you want to try and make them more sophisticated or good, I mean, as a researcher, obviously I'm going to love that. But whether it's necessary or not, I'm not sure. I don't think we're far enough down the route to know that.
Okay. Chris, just coming back to yourself, if I may, I understand that prudent value as a concept, it's not confined to real estate as an asset class, and that there's been previous implementation, for example, with financial instruments in Europe. I'm wondering if there's anything we can learn from that experience with prudent value elsewhere on how to get it right.
Well, yes, I mean, I think it's quite instructive. I mean, Neil mentioned the global financial crisis of 2007-8 as being a driver for Basel III, which it was. But of course, the fact that it took them until 2017 to come up with amendments to real estate collateral shows that it's quite low down the priorities. Financial instruments were by far the biggest asset class, which was causing of the bank problems back in 2008. They introduced, certainly in Europe, when Basel III came out with its prudent value proposals for or amendments to financial instruments. Prior to that, the prudent value was deemed to be either marking the instruments to market or marking them to model. In other words, depends how well they were traded. If you have market evidence, you use that. They again complicated it somewhat. At about the same time, the international accounting standards were revising their own requirements for the accounting for financial instruments. When the European Banking Authority were asked to produce regulatory standards of how this new prudent value should be calculated, the banks all said, well, we're having to calculate the fair value of these instruments on a daily basis sometimes. You know, we do not want to have to calculate a completely different value. And in that case, the solution which the European Banking Authority came up with in its technical regulations, which are mandatory across the EU, and as far as I'm aware, were adopted also into the UK on Brexit, because nothing else has yet replaced it, is that where it was possible, and bearing in mind that most financial instruments are traded in their millions on a daily basis, and it's all on screen and the prices are there for anyone to see, that if there was the fair value had a 90% confidence interval, then that would count as a prudent value. So in other words, unless you fell outside that margin, the value would be deemed prudent. The problem is, I mean, there's a danger there that if the EBA suddenly think, well, this is the way to go for real estate, because there's no way with a liquid and heterogeneous asset like real estate, you're going to be able to calculate confidence intervals in the same way you can with financial products. So that doesn't set a precedent, but the fact is they've linked it closely to fair value, I think is an encouraging one, because fair value, market value, you can substitute the two things. So it'd be interesting to see which way they go, because we understand that the EBA is to be tasked with reducing technical standards for, you know, applying the new paragraphs in the capital requirements regulations to real estate. So we'll see what happens.
Okay. We're rapidly running out of time, but if I can just take a couple of questions from the question and answer box. We have a question from Brian Balcicino. Thank you for your question, Brian. For commercial property, why not adopt vacant possession as a prudent valuation methodology? This is an existing measure that is available for an RICS valuer as a standard, aligns with the framework, and more is straightforward to implement. And any responses on that one, Neil?
Yeah, can I have that one, please,
Sure.
Chris, if you don't mind?
No problem.
UK Finance, in their response to this consultation, I believe, are going to say exactly that, is that I'll just use VP. So VP is market valuation subject to a special assumption, and there's nothing to stop you in the framework that I'm suggesting is that we need a market value for each individual asset. If it is appropriate to put market value subject to vacant possession for the particular asset, nothing to stop you doing that. That is the market value. But it is market value, I think. I'm sure Chris will put me right if I'd say this wrong, subject to a special assumption of vacant possession. And I can think of examples when that is absolutely feasible. Does not address the major problem. The major problem is not specific asset valuations. The major problem is cycles. The major problem is property markets crashing, and in the words of the head of the international the Independent Commission on Banking in 2011, he addressed I think it was the London Business School when he was doing his report on the global financial crisis, and he opened with the problem we have is something. Obviously, I'm not paraphrasing here. I am paraphrasing. I don't know the exact words, but it was basically the problem is the financial system could not resist a major property market downturn. And so he pinned his opening statement onto the commercial real estate market. He then did not mention commercial real estate for the whole of the Independent Commission on Banking's report. In other words, that's how important we were for the crash, but as part of the solution, at that point, we were ignored completely. They're going to break the banks up. They're going to do all sorts of things, but they didn't think that the one that he pinned as the cause. So vacant possession value does not address that issue. So I think that's fundamentally wrong. And I have written to UK Finance to tell them that if they put that forward, then they are undermining the outcome for the UK real estate industry, because you will get prudent value, but you might say that they will say that market value with vacant possession is the prudent value. That is inappropriate for some market valuations, for some circumstances, in my opinion. But it doesn't address the problem. So we might well be the cause of the next financial crash if that is the solution. The other thing I'm going to, I think, pick up from Chris, the risk weighting issue, that is the one that is exercising the real estate finance industry far more than prudent value. And so they do think it's an incredibly bad double whammy, that they might get a prudent value which reduces the valuations, and they'll get loan to value ratios on the standardized approach, which is the major criteria for the standardized approach within the regulations, and that the risk weightings have been moved up quite significantly. So they think they've been hit twice, or they could potentially be hit twice. And they're concentrating on trying to get the risk weightings back to what Basel III has got, as opposed to what the PRA has worsened them, in their opinion.
Okay, Fred, going to have to end the discussion there. It's just about time to finish up. So all that remains before we close is to extend some thanks. Huge thanks, of course, to Neil and Chris for updating us on this important topic and for an interesting discussion. Thanks very much. Thanks to Fiona from our engagement team for making today's webinar happen. Finally, thanks, of course, to yourselves for attending or listening in to this webinar. I hope you found it useful. Just to close by saying that RICS is in the process of responding to the PRA's consultation, which is due by the end of this month, and we'll be keeping you informed as this issue progresses. In case of any queries, you're welcome to contact us at our email standards@rics.org. Otherwise, thanks very much. We'll see you again, and goodbye. Thank you.
Okay, thanks, Jonathan. Bye-bye.
Thank you. Cheers.
Thank you, Jonathan.
Cheers, Neil.